three things just happened. Silver collapsed in a violent downdraft, slicing double digits off its price in a matter of sessions. Billions in futures exposure were liquidated. And while retail traders were watching headlines about inflation and geopolitics, institutional positioning quietly shifted in a way that almost no one is talking about. This is not noise. This is structure. And when structure changes, price follows. Right now, silver is trading at levels that don't reconcile cleanly with the macro backdrop. Inflation volatility is elevated. Real rates are unstable. Geopolitical risk remains embedded in global supply chains. And yet, silver experienced a sharp, coordinated sell wave that looked less like organic fear and more like strategic distribution. They didn't panic. They sold. There's a difference. Mainstream financial media framed the move as profit-taking. Some called it a healthy correction. Others blamed algorithmic momentum unwind. But when you overlay positioning data, policy timing, corporate earnings signals, and the calendar for upcoming contract events, a different picture emerges. And that picture is not random. Here's what most people missed. The scale of futures exposure that changed hands during the drop represented multiples of annual mine production. The notional value of contracts that rolled or closed was large enough to impact delivery expectations. And this happened as policymakers are navigating an extremely delicate balance between inflation containment and growth preservation. At the same time, corporate earnings from key industrial sectors revealed margin compression tied to input costs. Silver is not just a monetary metal. It is an industrial input in solar panels, semiconductors, EV components, and advanced electronics. When corporate reporting shows cost pressure and hedging adjustments, it matters. And there's a date on the calendar that could amplify everything. An upcoming expiry and delivery window. A moment where paper meets physical. That's when price volatility tends to expose structural weakness. So the question isn't whether silver is volatile. Silver is always volatile. The question is whether this market is still functioning as a traditional price discovery mechanism, or whether it has transitioned into something more mechanical, more policy-sensitive, more derivative-driven. If large players are reducing exposure ahead of policy decisions, if corporations are signaling cost recalibration, if contract structures show rising stress near delivery periods, then this isn't just a pullback. It's positioning. And positioning tells you what institutions believe before headlines confirm it. Tonight, we are going to connect government policy signals, corporate earnings, evidence, derivatives math, and supply-demand dynamics into one coherent thesis. No conspiracy tone. No dramatic exaggeration. Just institutional logic. Because when you step back and map the flows, the numbers don't lie. They sold silver. And what that implies about this market may change how you interpret price from here forward. Let's break it down. First, policy. Markets don't operate in isolation. Silver does not float independently of government influence. Monetary policy, fiscal positioning, regulatory oversight, and macro signaling shape liquidity conditions. When a senior government official speaks about inflation, growth targets, or interest rate trajectory, markets react instantly. But what's more important than the headline reaction is the positioning that happens before and after the speech. If policymakers are signaling tighter financial conditions, higher for longer interest rates, or slower balance sheet expansion, real yields adjust. Silver, which does not produce cash flow, becomes relatively less attractive when real yields rise. But here's the nuance. Silver's reaction to rate policy is nonlinear. When rate hikes signal economic strength, industrial demand offsets monetary headwinds. When rate hikes signal slowdown, industrial demand contracts while safe haven flows remain inconsistent. This creates a volatility pocket. If the named official recently reinforced a hawkish stance, emphasizing inflation persistence or labor market resilience, institutional desks would interpret that as potential pressure on liquidity-sensitive assets. And silver is liquidity-sensitive, not because it's weak, but because it's leveraged through derivatives. Now, consider corporate earnings. Industrial manufacturers recently reported revenue figures that were stable on the surface. But cost structures told a different story. Margins compressed. Inventory adjustments increased. Forward guidance included cautious language around raw material pricing. Silver sits at the intersection of green energy and advanced electronics. Solar manufacturers require it. Chip fabricators integrate it. Automotive electrification increases demand for conductive metals. So when earnings calls mention input volatility, hedging strategies, and procurement adjustments, it's not abstract. It's signal. Two interpretations emerge. 1. Corporations anticipate softer demand, so they're hedging downside risk in commodities. 2. They expect continued volatility and are managing exposure ahead of contract expirations. Which is more probable? If earnings show stable top-line growth but cautious margin commentary, it suggests cost management rather than collapse in demand. That leans toward volatility management rather than demand destruction. Now we enter the structural core, futures mechanics. A standard COMEX silver futures contract represents 5,000 ounces. If 50,000 contracts trade in a single session, that's 250 million ounces of notional silver exposure. Global annual mine production hovers around 800 to 900 million ounces. So a few days of heavy futures trading can represent a meaningful percentage of annual physical supply, at least on paper. But most futures contracts settle in cash. Very few go to physical delivery. This is normal. However, during periods of stress, the ratio of open interest to registered deliverable inventory becomes critical. If open interest equals 150,000 contracts, that represents 750 million ounces. If registered inventory available for delivery is, for example, 40 million ounces, then coverage ratio becomes tight. Though again, most contracts close before delivery. So why does it matter? Because if more participants choose to stand for delivery than usual, stress increases. If large players anticipate stress, they reduce exposure before expiry. That can create sharp price moves. Now factor in crash percentage. If silver dropped 12% in a short window, that's not unusual historically, but context matters. Was it accompanied by rising volume? Did open interest decline, suggesting liquidation? Or did open interest increase, suggesting new short positioning? If volume spiked while price fell and open interest decreased, that implies longs exiting. If volume spiked while price fell and open interest increased, that implies aggressive short selling. Those are different structural messages. Then consider rebound behavior. Did price snap back quickly, indicating strong dip buying? Or did it grind sideways, suggesting distribution? Volatility tells you about conviction. A fast V-shaped recovery implies liquidity waiting below. A slow drift implies caution. Retail coin shortages can occur even when futures markets are well supplied. That's because wholesale bars, ETF inventory, and exchange warehouses operate on different logistics timelines than coin dealers. Tightness in retail does not automatically equal systemic shortage, but persistent backwardation, where near-term futures trade above longer-term contracts, can signal delivery stress. If backwardation appears near expiry, that's a flag. Not a guarantee, a flag. Now synthesize timing. Government official commentary sets macro tone. Corporate earnings reveal industrial sensitivity. Futures positioning shows mechanical leverage. An upcoming expiry date concentrates exposure. If institutions sold silver ahead of that window, it suggests risk management rather than panic. So what does that mean probabilistically? Low probability scenario. This is routine volatility in a structurally stable market. Medium probability scenario. Policy uncertainty plus delivery window creates short-term stress, leading to price overshoot before normalization. High probability scenario. Liquidity conditions are tightening enough to expose structural fragility in derivative-heavy pricing mechanisms. Which scenario dominates depends on two variables: policy trajectory and delivery behavior. If policymakers maintain restrictive posture and real yields remain elevated, silver faces headwinds. If delivery demand exceeds historical averages during expiry, stress increases. If both occur simultaneously, volatility expands. But this is not a binary collapse narrative. It's a structural evolution. Markets today are more derivative-driven than decades ago. Price discovery increasingly reflects positioning flows rather than physical exchange. That does not mean the market is fake. It means it's layered. And when large institutions reposition aggressively, price can temporarily disconnect from intuitive narratives. So when we say this is not a real market anymore, what we mean is this. It is no longer a simple supply-demand exchange. It is a liquidity ecosystem. It is influenced by policy signaling, corporate hedging, algorithmic momentum, and contract structure. Silver is both metal and macro instrument. And right now, the macro instrument component may be dominating. Let's step back and identify the strongest signals. First, the magnitude of futures volume relative to physical production. Second, corporate earnings revealing cautious input management rather than demand collapse. Third, policy communication reinforcing tighter financial conditions. Fourth, an upcoming contract window that forces exposure decisions. Together, these form a mosaic, not proof of breakdown, but evidence of strategic positioning. So here's the thesis in one sentence. They sold silver not because the metal lost value overnight, but because liquidity, policy timing, and derivative structure made it rational to reduce exposure ahead of potential stress. Current price levels must be interpreted within that framework. If silver stabilizes above recent lows despite policy headwinds, that signals underlying demand strength. If it fails to recover into the delivery window, that suggests broader liquidity caution. Forward catalysts are clear. The upcoming expiry date, policy meetings, inflation data, industrial production numbers. Each one intersects with silver's dual identity as monetary hedge and industrial input. Risk factors exist. A stronger dollar could pressure price. Unexpected policy easing could trigger sharp short covering. Industrial slowdown could dampen demand. Or geopolitical shock could reignite safe haven flows. Nothing here is guaranteed. But positioning shifts are rarely random. So ask yourself, if silver reclaims previous highs, what does that imply about liquidity conditions? If it breaks lower into expiry, what does that signal about delivery confidence? Price targets matter less than structural interpretation, because in modern markets, mechanics drive momentum. This is analysis, not financial advice. Do your own research. And remember, when institutions move quietly ahead of the calendar, the story isn't in the headline. It's in the structure beneath the price.